everyone. Next, we have with us a highly valued contributor to the blockchain space, Alex Albano. Alex is the Director of Marketing and Sales at Chainstack's Blockchain Managed Services and the founder of the blockchain consultancy, Ashra Labs. She has previously been the CEO of the Space Chain, instrumental in creation of the first decentralized network of satellites, also the part of the team that made the installation of a Bitcoin node on the International Space Station a reality. She has been the founding member of the Ocean Protocol, a decentralized data exchange that has been advising a number of blockchain projects such as DexTF, Decentralized Traded Funds, Mahadavo, the world's first non-depreciating currency. She has a significant experience in structuring and scaling up operations for startups and bringing up new products to the market, particularly in blockchain and data innovation projects. She has been instrumental in commercializing technologies that have attracted significant investment by major venture capital funds and corporate partners. She has held full budget responsibility for many million projects in aerospace and automobile, government and public-private partnerships, education management, and digital innovation projects. Alex has been nominated to the inaugural of IMDA's 100 SG Women in Tech, also the Oxford Set Business School and INSEAD Executive Education alumna. It's a great honor to have Ms. Alex today at the two-day workshop for women. She'll be keynoting on the much anticipated topic, DeFi, the future of finance. On behalf of KB and KB Women Connect, I extend my heartfelt gratitude to Alex for joining us today live. Over to you, Alex.
Hi, everyone, and thank you so much for the introduction, Andrew. It's such a pleasure to be here. I've been looking forward to this session for the entire week. I feel a little bit nervous, guys, because this is an interesting topic and we have so much to cover. I hope we will do so in a sufficient in-depth way, but if not, feel free to ask questions. If there is anything that you want to ask or anything that I'm not covering to sufficient level of details, or I'm going too fast, just stop me and ask. This is, I hope, a very interactive session as well. I will ask you questions. You can ask me questions. It's not like a front end where, just look through the mirror glass and so on. It doesn't want to be that way. If that is okay, I will try and share my screen. Let's see if everything goes all right. I hope you can share my screen now. Yeah, is everything okay?
Yes, perfect.
Awesome. That was the riskiest part, probably. So that bit we have done. So thank you, everyone, for being here today. Today, we are going to cover a lot. We're going to start and look at what is DeFi and what it is, the differences between DeFi and CeFi. CeFi is centralized finance. I thought it would be interesting also to take a look at what's been the history of DeFi and why we are where we are. Otherwise, it always feels like an incomplete story. You feel like if you're just starting up now, you haven't been part of the evolution of it up to this point. But let's bridge the gap and look at everything that happened up to today's with DeFi. We will look at what you can actually do within DeFi. There are different areas that are in common with traditional finance. And to a different level of details, we're looking at lending and borrowing today. Flash loans, I will touch just briefly on that. We'll look at stablecoins, including CBDCs, decentralized exchanges, derivatives, margin trading, insurance, and then a very important bit, which is the oracles upon which the entire DeFi is based on. And I will offer you my my thoughts about what are the barriers for the DeFi for the near future and what are the prospects and the main areas of work. Brilliant. So before we start, of course, as we touch about regulated industry, just know I am not offering financial advice. I'm not a financial advisor. I'm just a very curious person reading and learning and living in the blockchain space for quite some time. We are here to learn, so I'm going to learn from you guys, same as you probably will take away, I hope, something useful from this session. But that is the main reason we are here. So not financial advice. As you will get inspired, I hope, and you will start to get more active if you have not done anything before, or you've just done the superficial level. Just know that before investing, you have to do a lot of research. Find a buddy. I know that works quite well. If you don't know of anyone, please reach out to me. I put my LinkedIn details everywhere. Just reach out. I will be happy to find your body to try and learn together with you on the DeFi space. DeFi is a high rewards but also high risk space. So be extra careful and invest only what you can afford to lose. That's very, very important. You will see the numbers are just astonishing, but it comes at a price. So be careful when you're in this space. It is also non-regulated. You will see there are drawbacks from that. And just a quick note, I'm happily director of marketing and sales at ChainStack, a blockchain managed services. However, today I am just speaking as myself, and none of the things that I will say today will be like official endorsement from ChainStack or any official opinion or position about the project I will mention today. Okay. Let's get started. But before we do, can I just ask for a raise of hands? I know you can Zoom. We can bypass being in the same room. We're having some tricks. But raise of hand, how many of you have actually opened or have ever opened or are keeping a MetaMask account? Like, do you have a MetaMask account? Have you done any DeFi or any investment? If you haven't, brilliant. Today we're going to cover all the basics. If you have, brilliant, contribute and add if I have any gaps, just out of curiosity. Maybe Andrew, Kartika, you can let me know afterwards, what's the proportion of people who have just started.
Yeah, sure.
Brilliant. Okay, so let's get started. So, how are you? Let's go. The first thing that you need to know about DeFi is that, of course, it's decentralized finance. And what do we mean by decentralization? Every time you hear decentralization, think about shift in power dynamics. And that shift is enforced using code. It is very important because that is kind of going to be your test. Is this decentralized or not? Ask yourself, has there been any substantial shift in power dynamics in the decision making? And I want to say this as we start because you will see that DeFi and blockchain in general is as much of a technology as it is a political activity. It has to do with shifting what is the ability for people to make decisions and to have a voice, and to break monopolies, and to break also the closed door approach on what is, to great extent, the traditional finance. So you will hear, quite often blockchain being referred as a democratizing force. And that's, I think, what it means. That's the actual, not in a nutshell, that's the actual power of blockchain and decentralization. So shift power dynamics, and you will see throughout the process today, looking in depth into each detail why that is important. So DeFi doesn't care who you are, and that's very, very powerful. There are some set of rules that are encoded in the protocols, and everyone needs to follow those rules. Those who are, have experienced DeFi already, you will know that it is extremely, extremely fast. Although, there are concerns about the ability to perform transactions at the same speed as traditional finance, in reality, when you look at the actual products, you will see that the speed at which transactions are happening, or in general, activities for financial activities, it's nothing compared to what is on traditional finance, and that's mostly because it's peer-to-peer and it is automated. You will find that in DeFi there are lower fees because everything is transparent. So there is only so much that you can get away with from doing a ripoff, because also a lot of the projects are open source. If something is not good enough for the customers, someone will pick up the code and do a product that it is more price competitive. So there will always be something that is customer centric. And in terms of costs also, it will be much easier to run a DeFi project because there will be everything on chain. The accounting is much easier. It is transparent, but it's also easier to execute. So there will be less human capital. When you think of a bank like Citibank or HSBC or CBC, you name them, how many people are, behind closed door, in front of a spreadsheet doing a lot of numbers. With DeFi, teams are much smaller. There is no need of, that big machine at the back. The other thing that is very important, DeFi, very interesting, is that interest rate in generals are configured as part of the protocol, and they are calculating based on supply demand and with risk parameters of the assets that we're touching on. So that's something that it's automated and it's transparent. It's very interesting, and it is applied equally. And of course, as blockchain goes, there are no intermediaries. There is no what the most ideological DeFi people would call parasitic layers. Let's call them no value add layers. So that is removed. There is only the protocol and the user. And I think something that you will find as part of the culture, the community, which is as fascinating as the technical aspect, is this idea of irreverence and playfulness. You'll see there are strange and weird things going on in the community, but that's quite fun. Whether you're planning to work within the industry or just be a consumer within the industry, be ready for definitely untraditional moves and names and terms. And probably the best bit about DeFi is the sense of community that is bringing everyone together. There is a sense of shared values on community and shared willingness to break the rules and get something better at scale. So DeFi is a new financial system, which is both alternative and complementary to CeFi. I actually don't believe that everything will be replaced necessarily. You will see banks are actually moving quite quickly into incorporating DeFi products and even cryptocurrencies as part of what they're offering. There is money to be made for them. It is better for customers. It lowers costs, so why not? Everyone can improve with that. There is no culture war that way. DeFi, in a nutshell, is finance that is built using cryptography. It is definitely done on a blockchain, and it is done so thanks to smart contracts. Probably over these 2 days, you've heard quite a bit about what smart contracts are. I don't want to go into the depth of that. Just know that because of the complexities and potential of smart contracts, the majority of DeFi is built on Ethereum. And that's because there is the language program called Solidity that will allow for that complexity to be executed. So when every time you hear smart contract in DeFi, but in general, just think about an input that execute a logic and that then update the blockchain state, in accordingly. The other thing is it's done irreversibly. So there is no way that you can then go back, and that's the risky bit, but also the bit that makes it so powerful and allows for the disintermediation of some of the layers. We are going to get into the details of all of this, but I just want to go in broad terms to begin with. Smart contracts allow to build the logic for DeFi, and it is an ecosystem that leverage network effect. The other important aspect, and you probably heard this before, crypto never sleeps. You will see CeFi does need to sleep, does need to recover, that needs to have closed doors sometimes during the day, to clean the house, look at the inside the cupboard, close the doors and do whatever it needs to do. Crypto is always open and it's always auditable. It's always there, it never sleeps. It is open to everyone. And you will hear these words quite a lot. If you want me to get into more details, but just let me know. It's permissionless, and it does enables cooperative work thanks to being open source. If there is one message that you want to take away today, is really that centralized finance allows only for banks and financial institutions to create financial products. DeFi breaks that dramatically. So that opens opportunity for everyone. So when we're looking at centralized finance, we're seeing that, right? It's happening behind closed door, and it is done by a group of privileged few. We know, even if we're not looking at the problem of diversity in itself, even if in terms of actual execution, there are in the end very few people that have got the knowledge, access, network, and actually the jobs to actually execute the things that are happening in finance. There are massive inefficiencies within centralized finance that produces a lot of cumbersome processes. Because even though there is a nifty and easy to see UI UX, due to the very expensive compliance costs or regulation, and the big machine that needs to happen at the back, even the most advanced and user-friendly traditional financial products require a big machine behind the screen. Always remember that DeFi is challenging it. Other important things on CeFi, you've heard quite a bit probably about having DeFi, or in general, blockchain, trying to bank the unbanked, and providing financial services to those who traditionally don't have access to it. If you look at it, centralized finance does have limitation. We'll tell you you can or you cannot. They will decide. They are the gatekeepers because they are centralized, and they will make the decisions based on certain criteria. The other thing, if you have ever tried to launch a product within banking or finance, the barriers to entry are incredibly, incredibly high, which suits well the incumbents. They're very safe. They know that they have to spend a lot of money to get into the market, but then they can just do their thing, because there will be, only so many competitors will come into the market. It's kind of a self-regulated competitive market. There will be slow innovation. That means that they can charge high fees, and they can just, get along with each other, get along with the regulators, and do their best, within a very complex system. Finally, final, but not definitely the last, when it comes to centralized finance, everything is built to be proprietary, closed, and protected. And that's, maybe we can touch maybe another time on how banks are actually trying to innovate using blockchain. And there is a bit of friction because their systems are not designed to be collaborative and open. So you will see over the next months and years how banks will actually be able to embed DeFi or just crypto within their current infrastructure. So just a quick promenade across the history of CeFi. It's been like decades of technological innovation. In the 1920s, we're just a counting machine and punch cards. In the 50s, we've got computers coming on board. Then there will be ATMs, credit cards. Stock markets started to get computerized. There will be the beginning of what will become algo trading. So automated trading using computers, computations, very complex calculations behind it. In the 1990s, the internet booms. That created different level of relating between the consumer and the banks. Like people will, started to expect to be able to bank from their own house. And in the 20s, the 2000s, that really boomed into what is the fintech revolution with the tech-first approach. You will see like PayPal, TransferWise, Robinhood, and so on. But ask yourself, have the power dynamics changed? No. It is still a centralized entity makes the decision, and they decide whether or not you can access the services or not. It's still centralized finance. Even the more sophisticated and user-friendly fintech, it's still centralized. So let's get into the decentralized part. What is actually changing? You can have very efficient services. You have immediate settlement and no geographical barriers. Interesting to see how the regulatory bodies will actually respond to this. You've seen India has been very, very prudent, very slow, if not hostile towards the crypto space. But we will see some city-state going to be faster to adapt. Like Singapore is being, definitely one of the where I am like now based. One of the fastest to embed and experiment with it. You will see when we're touching CBDC, you will see that Singapore has actually done quite a bit on that. But in general, geographical barriers really DeFi don't care about it. It is fair and unbiased. There are a few projects that call themselves unbiased tokens. That means that you have equal treatment. It's not about who you are. It is only about what you can do within the DeFi space. Especially for loans, that will open a lot of opportunities where before there were closed doors for social reasons or economical reasons and so on. It is permissionless. As long as you've got an internet connection, you're fine. No other prerequisite. That's all you need to be part of the DeFi space. And it is censorship resistant. I don't know if you've followed everything that happened with the GameStop. There's been, if you followed there, you will know that Robinhood was helping non-institutional investors to buy stock and do their own bids and try to make exceptional profit out of shorting certain stock. But eventually, they decided that it was enough, and they just pulled essentially a killer switch, and they said, enough, you cannot do it anymore. So on DeFi, that it's not possible. There's no single party that can just deny you access or just pull the trigger and say, no, enough. It is not anymore in my interest or in my investors' interest. And once the protocol is there, that's what decentralization is. It will just keep going. And we will see there is also a degree of decentralization. Not everything is fully decentralized, but I'm not going to touch on that at all today. It's a talk on its own. But in a nutshell, multiple parties cannot just change rules. Even if there are many of them, they will try to collude. If it's robustly enough, robustly built, then DeFi is unstoppable. In fact, that's another word that is used quite a lot: unstoppable systems, unstoppable applications. And it is transparent. As it goes for financial products, everything is on the blockchain. It is feasible. If a protocol is offering services to you, you want to check, you can see, it's very easily to find what they call explorers or, like CoinMarketCap and other services where you can look at trading volume, outstanding loans. Everything is for everyone to audit. And if you've seen like what happened with the 2008 financial crisis, that was the exact opposite of transparency behind closed door or what was going on. Finally, it is open, so everyone can contribute. And that's my personal request to everyone in this room. I know it's quite a few of us connected together, virtually together here today. We need more diversity in the community and in the industry, both gender and representation. It is getting better, but it is still not as good as it can be. So please, roll up your sleeves and then just try it out. I'm pretty sure this writer, this poem, but you cannot cross the sea merely by just standing and staring at the water. So after this talk, just get involved, get a new project or get as a customer, build something. It is possible. It is doable for sure. So why do we care about DeFi? First of all, because of the incredible growth that we've seen over the last 12 months alone. The total value locked in, which means the total value that is collectively across all the protocols in the DeFi space, has grown from 1 billion to over 32 billions and USD. And I don't know if you can think of the scale of this, but that was just in, let's say, 10 months, 11 months. That's absolutely astonishing growth. The trading volume has gone from $500 million in April 2020 to over 50 billion in, I think it's January 2021. And the total value settled on Ethereum now, it's over 1 trillion, which is more than PayPal. So we are getting there, guys. Things are moving. But how did we get here? So let's get into like the history. I will go quite quickly. I know that we have 1 hour, but you will see it's going to take quite some time to get through everything today. I want to spend some time on everything. So, of course, the beginning was Bitcoin in 2009. There were some limitations by design. It is programmed using programming language called Script that didn't allow for applications. And that's why Vitalik Buterin in 2015 came up with the idea of having smart contracts, a virtual machine. And ERC20, which is kind of the cookie cutter for building more cryptocurrencies, more what they call tokens on top of Ethereum. And that was in 2015. 2017, there was first move on building actual applications in finance. And the very first one was MakerDAO in 2017, what is called an unbiased currency with no volatility. It's essentially a stable coin. After that, there will be the first DEX, Ether Delta. Of course, it got hacked, which happened quite often in the early days. And in the end, it also got charged by the SEC for running an unregulated exchange in 2018. Sorry to break the news, but I don't think they're coming back anytime soon. I think that the project is gone for now. But there are many more that learned lesson from these pioneers and built more. If you have heard about ICOs, of course, there was a big spring in 2017, bridging all the way to mid-2018. And it was about fundraising in a new way. Again, democratizing fundraising. It was not about a single VC promising you money and asking you for a lot of equity. It was about instead offering tokens and going and crowdfund it, so offering to the public. If you believe in the project, buy the token, be part of the revolution, have skin in the game. So that was the ICO. Some were legit, some were just for the sake of the opportunity and made quite a lot of substantial money and disappeared. So bad rap that came out of it, and that kind of opened the crypto winter in 2018, 2019. But don't be fooled, the teams and the passion for the technology was still there. Everyone was busy behind the door building. That's how in 2018 Uniswap, one of the major project for DeFi, was funded with a small grant from the Ethereum Foundation. I think no more than, I think it's 20,000 USD. And you will see the magnitude that actually is now Uniswap holding in terms of total value locked and transactions, overall transaction. 2019 was the time for synthetics, the first derivatives on blockchain, decentralized derivatives, and other projects that are still there. Cabe from Singapore, OX, Compound, and REN. Everything was almost coming back to a spring, if not summer, when Black Thursday happened in March 2020. Probably, I don't know if it was fresh in your memories or not. I was very much glued to the screens and seeing the price tumbling down dramatically. ETH price went down 30% in less than 24 hours. Many projects lost a lot of their war chests. It was a big blow for the entire ecosystem. But that didn't last long, of course. Crypto just says, okay, shrugs it off. They said, let's build something better. And that's how DeFi Summer started in May 2020 with Compound and the Comp token. And actually, it was quite an interesting way of bouncing back. And it was the actual beginning to me of DeFi. This is it's pre-comp and post-comp. The actual DeFi Summer started with a post-comp in May 2020. So they built rewards and incentives for trading different tokens, which resulted in different annual percentage yields. And that gave the birth to yield farming. Probably heard, if you've been around the DeFi space, you heard about farming a lot. That's what it is. Essentially, you're looking at the annual percentage yields and you try to optimize it, switching across borrowing and lending using different tokens in your basket. That opened opportunity for new companies, new protocols to start up new projects. That's how Yearn Finance started in early 2020. And that became essentially what's a robocall. It's an automatic switching between lending protocols. That was like a hugely positive response with the beginning of liquidity mining. They issued actually their tokens via liquidity mining, and it rose from $6 per token to 30,000 in less than 2 months. That's really like astonishing growth with a lock value of over I think it's 630 million actually. As things go, you will see that vampire icon over there. That's the beginning of the weird DeFi stuff. But in August 2020, Amplefort was born. We will see more in details about Amplefort later. It's elastic supply model, and yam is in like the potato, like the yam vegetable. That's the name of it. And it just was just launched in 10 days of code development. Absolutely no due deal, no audit. It was done. Honestly, it was done with no real purpose. It was just done to make some money. But people really flocked towards it, and they found a critical bug on their base mechanism. After $500 million value was locked into it, quite a few people lost quite a lot of money. That was not fun, and I think Yam still around. I don't think there will be a lot going on after this. It's the trust is gone in many ways. And in August, I don't know if you've ever heard about Uniswap. It is one of the most controversial moves and also gossipy things that happened in DeFi last year. It was launched by an anonymous team, and they launched what is called a vampire attack. They tried to siphon away all the liquidity from Uniswap. They managed to do so for about 1 billion, and that didn't go down well with the community. After that, there was a whole generation of what they call food finance or DeFi food. There was the pasta finance, spaghetti, kimchi, hot dog. They were all short-lived, and there was not much that actually was successful after that. That was the end of the summer. It is actually marked with the launch of the Uniswap token. With a retrospective airdrop, everyone got a lot out of it. Essentially, Uniswap token was given to the community for free, and people made more than $1,000 just because they were part of the ecosystem. As part of the liquidity mining program, then they raised about 2 billion, and they managed to reverse the vampire attack from Uniswap, got quite a bit back. Now it's grown quite a bit from 169 million in August 2020 to just now around 15 billion, and the total value locked overall just now at the end of the summer, it was back in till September 2020 up to 10 billion. So after that, again, you see in crypto we talk about spring, summer, and winters. Another winter, everything went down 70 to 90% token price. It was not pleasant, but honestly, it still was quite remarkable. It bounced back quite immediately, 50%, and the value kept increasing and increasing, even though we're in the middle of the DeFi winter. Hitting just now, February 2021, we are at 32 billion. If you think that just started in April 2020 overall, that's astonishing. That's quite amazing. And you will see just now where we are now, there is what I personally call memes finance, with project with no real purpose. They're quite fun, but who knows? And you will see a lot of movement in that sense. And of course, NFTs. I know there have been already talks about NFTs, so you know everything about NFT. I will not touch on NFTs today, but that's what I personally think it is. It's just that's the season of NFT. Okay, a bit of a breather. If you have questions, just stop. Andrew, feel free to stop me with any questions if at any point they're coming up. That was like a brief but intense overview, and now we're going to get deep into each of the DeFi categories. It's going to get a little bit more technical. Hopefully I will do a good job. If not, stop me and ask me a question.
Yeah, sure. Cool. As of now, we don't have any questions. Maybe they may drop at the end of the session. You may continue.
Fantastic.
Yeah, thank you.
Fantastic. Thanks a lot, Andrew. Okay, so lending and borrowing. We all know what it is, right? There is nothing, the concept is the same. You got a lender who provides funds to borrowers in return for interest on their deposit. Borrowers and loan takers are willing to pay some interest on the amount that they borrow in exchange to get some funds right away, right, for whatever need. That's the mechanic of lending and borrowing. That's not changed. The first innovation was with introducing crypto as part of the lending and borrowing. But that is still done as part of a financial institution. It's still centralized with crypto banks. So essentially, you can borrow Ethereum or you can borrow Bitcoin or any other token. That's still traditional borrowing and lending. And because the assets are still held by a third party. So it is not peer-to-peer disintermediated or with a protocol that is doing a smart contract that is executing it. You're still giving it to an institution who is mediating it, and you have to trust them with your asset. So when it comes to borrowing and lending, just crypto is same vulnerability as a CeFi. Now in DeFi, that gets broken up because borrower and lenders are able to interact with one another using a decentralized and permissionless ecosystem. And they are able to also maintain full custody over their own tokens. And they're able to do so because there are smart contracts that are executing this logic. How does it work? You've got a supply that comes from on the lending side. Let's say that you want to make some money, earn some interest by lending some tokens to someone else in the system. You supply your tokens to the protocol. Yeah, you send them to a smart contract essentially. Now they are available to other borrowers. They can just take it instantly, right? It is there is no like agreement, contract sign, or like can you do it, can you not do it? No, it's disintermediated. You say, okay, you've got an account, you want to borrow, just take this money. When you are lending the tokens, you are being given a native token from the protocol that represents the value of the tokens that you have supplied, plus the interest that you're going to earn. So to get your fund back, you have to redeem them by giving these tokens to the protocol back, to the smart contract. So the smart contract will say, okay, this is the equivalent, and you can get back whatever amount you have given to others for borrowing. There are specific tokens that they use for compound. They're called C tokens. For Aave, which we're going to talk now, they're called A tokens. So it's very secure, actually. It's very safe. DeFi loans are over collateralized. What does it mean? It means that every time the amount that is taken out for borrowing, it's much lower than what it is put in for lending. It is, it is forcefully and strict. So why do you want to borrow? Primarily, it is because you want to maintain your tokens, but you still want to have some liquidity at the back. So you don't want to necessarily sell the tokens that you have because you think that maybe you will appreciate over time, or you just want to, keep them for your own portfolio without selling them. You can just park them and earn more than what you would otherwise by just having them in your own wallet, in your own custody alone. And how much can you borrow? Anything. There is no limit there. And it is not means tested. That's the thing that it's very different in DeFi. It's not like someone is coming and saying, oh, because of so-and-so, because of the jobs that you have had or not have had, because of the income that you now have, or because of the place where you live or the age that you do have, that you are at, then this is the amount that you can borrow. No, as long as you post collaterals, you're fine. And collaterals are transparently calculated by the protocol according to a very fair and equal dynamic called collateral factor. So that applies to everyone. There is no adjusted risk factors in that sense. As long as it's for a certain pair, that's a collateral factor that is calculated there. So you can, but however much you want to borrow, that must always be lower than the collateral that you're posting. And if it falls lower than what is the threshold that you have stipulated, then your collaterals are going to get liquidated by the smart contract automatically. It's very transparently done. And there is no time limit. Plus, the lenders will receive an interest that, again, is determined automatically by the protocol based on the ratio that there is between the supplied and borrowed tokens. So, the rarest the token is, of course, the more interest there is for that token, the highest the interest rate is going to be for that specific pair or token. One project that has been hugely successful, we mentioned it earlier when we started with a pre-comp, post-comp, that's actually compound. That's the nice logo that they have. 630 million of value locked. The interest rate in this case is calculated algorithmically, and it is done in an autonomous way. There is no accountant or trader sitting in the back room and saying we shall post a different interest rate based on our own personal interest today. No, everything is calculated algorithmically with rules that you can see and audit in a very transparent way. And the supply assets for Ethereum, Brave. By the way, the browser Brave. If you're not using Brave as your own browser, you should. You can earn tokens just by having using that browser, and Tether and 0x. Plus, you can just post the collateral. That's mechanics that we've covered. Another interesting platform is Aave, which is Finnish for ghost. Hence their symbol, their logo is with the little ghost there. The A tokens are actually quite crafty because they don't just represent the amount that it is that you're lending. So it is not a one-on-one, but it also adds the interest within the ERC20 token itself, which means that it will increase over time. And the super crafty and interesting feature that they've created is that because it is an ERC20 token, you can even send it to others. So the other will receive a tokens that it is still appreciating because it will keep accruing interest over time. So it's super nice. Read more about it. It's a great project. Finally, they're really good at marketing as well. They call instead of tokenomics, Aavenomics, and they're using the tokens for governance. So that's when we go back to the concept of decentralization as also a power dynamic change. The token holders are those who are making the decision and can vote for governance. So it's there. I want to take a little bit of a breather, and then I'm going to quickly on the flash loans. I hope it's not too fast or too intense. Okay, flash loans. It's the same principle. It is a bit weird as a concept, but it is super crafty. Essentially, you can borrow any available amount that you want in terms of assets. You can do so with a smart contract that is pulling together a lot of assets, but you don't need any collateral, like with traditional DeFi lending and borrowing. So no collateral. There is, however, a snag, and that's why they're called flash loans. You have to borrow and repay it within the same blockchain transaction. So we're probably talking no more than 10 minutes apart. And you would say, like, what's the use actually for that? As there are opportunities now, computing power is so great that when you hear like algorithmic trading, they can actually take opportunities, even if it is a small margin on arbitraging or swapping collaterals at volume, at scale, can actually make quite decent money for traders. So that's what they're used for. They were very popular probably 4 months ago. There was like the flash loans summer. Just now, there's still a lot of innovation happening. Let's see where it will actually take us. Okay, now it's a big one. That's on stablecoins. So stablecoins are coming to try and break one major snag about cryptocurrencies, and that's about volatility. You'll see prices. That's the one thing that everyone knows. Price is going up a lot, is going down a lot, which is a good thing if you are using them for store of value. But if you want to use it for transactions or for e-commerce, then it's not going to be a good thing for you. So they come up with a new concept for cryptocurrency, and that's where stable coins are coming. That's stable, right? They're not fluctuating. They're trying to keep it with a stable price or relatively stable price throughout the life cycle. So, like fiat cryptocurrencies, of course, but even though like fiat currency, there would be like an depreciation. If stablecoins are pegged to the fiat currency, by fiat currency we mean normal currency like the dollar, the Swiss franc, and so on. So those are the fiat currencies. They may appreciate and depreciate over time, but overall they're quite stable. So they want to recreate exactly the same thing in crypto. Again, can be store of value. Many people will just make a lot of profit out of the arbitraging the volatility, but then keep the earnings into a stable coin, so they don't have to worry about volatility. So they will use it with what is called store of value instead of for speculation. And that can be quite interesting. How do they do it? They are using smart contracts to keep the price stable. I will get into the details now. But there are different ways of actually getting there. And there are also different ways to back this stable coin. Though some are using crypto and some are not. Some they're not backed at all. So the main difference are between algorithmics and non-algorithmic stablecoins. What does that mean? If they are non-algorithmic, it means that they have a fixed exchange ratio with the fiat currency that is backed by an actual asset, and that is done by a centralized entity that makes sure that there is always this value on a one-on-one or whatever ratio it is. Very popular USDT, USDC, and PAX. We can categorize it by the type of collateral, the type of banking, and you will see if they are completely collateralized, that means that they have assets including tier one, means like essentially what is the central banks are issuing, or they have fiat currencies that are backing it. For example, with Libra or Ikrona, that is actually a CBDC, you will have for one Libra coin could be $1. Okay, could be €1, could be like it's exactly the same ratio, but someone is actually holding that fiat currency in their own bank account, in their own in their own custody, to make sure that then the value can always be liquidated if that is needed, right? If it is collateralized with crypto, it's the same thing. The only thing, instead of having fiat currency at the back end, you will have crypto. So it could be that the one DAI equals one Ether. Okay. So you will always have someone, like a company, a centralized entity, that will hold those funds safe to make sure it is possible to liquidate them to back whatever is the need of the platform, right? Others are instead non-collateralized, and those are the ones that are based on algorithms, because they're using an algorithm to look at the price, so that if it is high or if it is low, it will get completely evened out over time. And now we're going to look into the details of it, so you can see some examples. The first one was basis. Then there is Ampleforth. If you remember, we had mentioned it earlier in the summer of DeFi, and one of the projects that I've been advising on called Mahadao, and that's also like a way for keeping the value stable over time. They're using algos for it, and then there are hybrids, of course, where you have part algorithms and part collaterals back into fiat or crypto. So how does it work? In algorithmic stablecoins, you have a fixed exchange ratio to a fiat currency, but that normally needs to be backed with a fiat asset. But instead, with an algorithmic stablecoin, to maintain value, you're just using essentially the issuance of bonds. You are incentivizing the community to buy or to sell, depending on where the price is for the coin. So when the price is increasing, you are issuing more coins. So there will be more liquidity, so people are buying more, so the price will go down. When instead the price is falling, you are, as a protocol, you are buying them off the market. That creates demand, so the price rises up. In that way, you can kind of balance it, and the algorithm will make sure that the price remains stable. Hugely crafty, great engineering that goes into it, fascinating. Read white papers, by the way. Never be scared of picking up and looking at the tech side. Even if you don't understand it first times, over time, maybe in a month, you will read more and understand more, and so on. Never be scared of looking at the tech side of all of these protocols. So Ampleforth, Mahadao, as I mentioned. And just know, though, that this is cutting-edge DeFi. People still don't know what are the implications of it. People are still experimenting. So approach with caution. There are good opportunities to make good money, and there are good opportunities to witness something quite epic for the entire industry. But just be careful. Also, because the code is enforcing all of these dynamics, regulatory bodies for now, they're not involved at all. So again, beware, but it's interesting. One specific type of stablecoin, they are CBDCs, or central bank digital currencies. You probably have heard that quite a bit. You have quite a few countries that have issued that. Some, of course, everyone is centralized because they're from the central bank. They are issued and regulated by the competent monetary authority, and they are used to represent a local currency. We still don't know. There are quite a bit of debate over, the backing of it in terms of reserve, but we will see where they will take. Each country is going to take a different approach to it, and they're designed to work alongside regulated money as a whole. Cool. Again, if you have questions, just let me know. Huh? So decentralized exchanges. What is an exchange? An exchange is when you've got some currency and you want to swap it with another, and you have an entity that will set the price and will tell you what are the exchange rate and the exchange fee, right? You have crypto exchanges where you can get fiat for crypto or crypto for crypto, and traditionally they are the bigger ones. They're all centralized. You are seeing Binance, Coinbase, Kraken, Bitfinex are probably the bigger ones in the market just now. Polonix, so many. You have with these like centralized crypto exchanges, there are of course liquidities. You will find fees that will charge you. They will accept credit cards in its very traditional experience. Also, as a customer, you will have your own cryptocurrency wallet where they will take and will keep your funds. You can keep it there, not that safe. Or you can just put the money that you need to exchange for just the time that you need it to exchange for, and then you're going to keep it on your own personal wallet, offline wallet, and cold wallet. There have been tons of hacks and scams, not on the more reputable now, but the crypto history is full of people just parting ways with everyone's money, so it's kind of a scary business. So be careful. Never leave your funds on a custodial wallet on an exchange. And they are working with authorities. They are fully regulated to an extent. They are, of course, doing KYC and AML. The experience normally when you're opening an account with an exchange, you have to give your passport, you have to give your proof of address, and so on, as if it was like a normal bank. And you will see like they're also cooperating with the authorities in many ways, like for taxation purposes and so on. Decentralized exchanges are very different. There is no central authority. Most are transitioning or have transitions under decentralized governance model, a DAO. You don't need to give up the custody of your asset at all. Some of them also don't have KYC. Some do. It's a mix. It's their choice. But essentially, you are able to swap currencies on a peer-to-peer basis, using the exchange, the protocol as a means to do so. Some are order book based, so you have a dynamic list of buys and sell orders, which is also how like Wall Street works. And some others instead are using liquidity pools, and I'm going to look at it just now. So you will have normally traditional order books, you will have market open and market close, where at the end of the day they will consolidate all the pricing and put up an opening price. With crypto exchanges, that doesn't work. Even if it's traditional model or order book, remember, crypto never sleeps, so it's continuous. There's never adjustment in that sense. The biggest and the most popular in terms of liquidity pools and so on is Uniswap. The tokens is Uni, and they're using smart contracts to make it completely decentralized, permissionless. Nobody has the power to deny you access to the protocol, as long as you do you play by the rules that are set on the protocol. And they're using what is called concept market maker to make sure that the rates are at market value at all times. Other decentralized exchanges are Kyber, Loopring, PancakeSwap, actually on Binance Smart Chain, and of course SushiSwap. That's a very good resource if you want to get into it. There is a great resource there. Brilliant. Am I overwhelming everyone, or are we still alive? I hope it's okay. 6 minutes to go. I hope we can cover and still leave some time for questions. This is a tough one. I'm gonna go as slow as I can, but it's okay. So when you're looking at derivatives, that's something that is massive, massive, massive for the financial market. DeFi is not very different. So what is a derivative? We've got a contract that derives the value from the performance of another asset. Could be stock, bond, commodity, interest rate, even a cryptocurrency. So why do you use a derivative? Normally you do it for two reasons. One is to hedge in order to manage your risk and get more stable income, or is to speculate, like really maximize your income. I'm going to try and explain in very simple terms how the hedging with the derivatives work, because that's quite relevant for DeFi. So let's planting wheats or like throughout the year is committed for the entire season. Now the price of wheat may fluctuate over time, and that's a risk, major risk to their income, right? So how can they try to hedge this risk? They may sell short future contracts. Essentially, they're saying at some point in time, the wheat will have that price. And I bet that actually at that point in time, the price will be lower than that. So if you're betting with me, then you can buy this short contract that I'm offering to you. When harvest time comes, if the wheat of the price is low, that short position that the farmer had will make profit. So whatever income he's losing because the price of the wheat is low will be compensated by the profit that will be done with the shorting of their position. If instead the wheat price is high or higher than what expected, then the short position will make a loss. However, in the end, the income will still be like the loss on the shorting position will be compensated by a higher price on the wheat. So that will reduce the risk of very dramatic difference between a good price and a low price, and it will make it for a very like a much more predictable income for the farmers. So that's used a lot in DeFi. You have heard about DeFi farmers trying to get yields and make the most out of their portfolio, but it's the same principle. Instead of wheat, they're doing it with their tokens. They're hedging the price of the tokens in this way, and they're using derivatives for it. There is also speculation, and speculators are actually very important for DeFi ecosystem because they provide liquidity. But I will not get into the details of derivatives as part of the speculation for now. Market is massive. You can see 1 quadrillion overall. For crypto, it's still relatively smaller, but I'm pretty sure it's going to grow quite a lot. Take a look. I will not get into the details of synthetics, but just know that it's super collateralized, 500%. That means that for every 500 tokens that are used for the backing of the synthetic assets, only 100 can actually be issued. So whatever was the big flow on the on synthetic products on traditional finance, and to an extent it still is of over leveraging it, DeFi has learned a lesson and is hard enforcing a very high threshold for collaterals. Margin trading is a bit hard. I'm going to go quickly through it. If you want to learn more, just let me know, and I can send you more details about it. But essentially, it's used to make good profit, really, really good profit. So you are just borrowing more funds based on a ratio that is called the margin from a broker to make sure that if you're very sure that your position is a winning one, you will make much more profit, even like extending onto what you can actually afford yourself. It's very risky. As much as you can increase your profits, you can increase your losses with it. But it is quite interesting, and I think we will see that as DeFi goes, there would be like a margin growth of this part of trading. Some example of products, DYDX and Fulcrum. And by the way, Binance.com has a great academy, like a knowledge center called Academy. Very, very welcome to use that for anything that has to do with DeFi. I have 2 more. I will go quickly to insurance and to oracles, and then we can wrap it up. For insurance, you know what insurance, right? You've got guarantee compensation in case something happens in return for you paying a premium all the time, right, on a regular basis. For DeFi, it's the same principle, but it's quite interesting because it is not done in a way that will benefit just the insurance company. It's done on a peer-to-peer basis. One good example is Nexus Mutual. I love the definition that they have given for themselves to describe what the product is. But essentially, they're saying it used to be mutual risk. It was a community-based model. It was not the adversarial model where you've got a large institution that dominates and and sets the premium, and it always squeezing value from the users. Should be like a shared risk across the community. So that's what they've built. It's a system that aligns incentives using smart contract code, and that's built on the Ethereum blockchain. Take a look. I mean, even for using it, I think mostly in DeFi space, it's used to protect against loss of funds or for smart contracts failures primarily. But over time, I'm pretty sure there will be products that will reach out on like healthcare and other or life insurance and so on that can be used in that way. Just the last one, and it's going to be super fast. That's on the oracles. Everything that we need on DeFi is based on data. So you need a bridge between what is the real world, the CeFi world, or the commodities, like the real life, and what is the DeFi protocols, right? They all the smart contracts, they need reliable copies or digital information about what is happening in the rest of the world, right? So that's what oracles are. Some of them are centralized, but they start to begin a whole movement on getting decentralized oracles that can be again trustworthy, transparent, and limit the reliance on single source of truth. Probably the best known project just now is Chainlink, but I'm sure there will be a lot of innovation and more projects coming up in this area. Good. So just to wrap it up, there are some issues. DeFi is not perfect. It's still nascent. Just remember April 2020, it was the very start. There will still be some bugs in smart contracts. There will still be some sudden protocol changes that you have to watch out for. There is also different degrees of decentralization. You probably have heard of all the debate with Binance Smart Chain, of the decentralized, centralized finance model that they are proposing. There will always be the risk of actually the entire model of a unstoppable system to actually have a killer switch. And that's a big debate in the community that is happening just now. We will see what it will take. There will also be always systemic risks, like the famous Black Thursday, where all the asset prices will be tumbling down systematically across the board. And of course, from a pure technology point of view, network fees, congestion, and scalability will probably be always an issue until we can find a better solution. But that's what it's nice about DeFi. We're pulling together as a community. Although everything is built on Ethereum, personally, I believe that there will be much more diversity over time. ETH2 is coming with the new different ways of doing the consensus. That will probably, surely help with the scalability of Ethereum itself. There are also a number of layer 2 solutions that are built on top of Ethereum to help with the scalability. And there are also new protocols that are coming with new smart contract capabilities. Polkadot, for example, is coming. And there are many others that are contending for specific use cases. Plus, there is a rise of hybrid centralized networks, and the holy grail, of course, is the interoperability between CeFi, DeFi, and public and permission networks. So let's see, let's watch it. But so far, it's very exciting as it is. I hope you can take away from today, some basic information about what is possible with DeFi. And I hope that you can reach out, to me personally or to the entire community. Just see if there is anything that you want to try and dip your toes in. It's not actually very different from any other project. Just get stuck in and start building. Okay, that's all on my side. I will stop sharing. Thank you so much. Probably I've taken 4 minutes longer than expected.
No worries,
So
no
sorry.
worries. Thank you. That was a brilliant presentation. You walked through the finer points on DeFi. I think many are newbies to the term. That's the reason we are finding little deficiency in the topics. The questions from the audience end. Maybe DeFi is destined to disrupt the traditional finance. Maybe the more education and more accessibility towards a DeFi will, get more people into the community, I believe.
Yes, and as a special message for today, especially the women's in the room, do get involved. Really, we don't have enough representation, and I'm very happy to be a bridge. If anyone wants to just reach out on LinkedIn, just do. I will introduce you to the network, or if you're looking for the first job in DeFi or in general in blockchain, reach out. Happy to be a power network in that way.
Thank you, Alex, for joining today.
Thank you, everyone. You take care.